Hey everybody, how are you everyone? This is Jose Blasco, March 24, 2022. This is our SMARTT Tiger Live session. How are you everyone? Before we get started, just 1 second. I just got the sound back on my ear. That was not nice. Now it's much better. I can focus on the session. As I was saying, welcome everybody to the session. And again, just before we get started, I wanted to make sure everybody understands I am here for you. And that means that I would love you guys to be engaged, jumping on the chat box with questions, with answers, with interaction with me, so we can have a more fruitful and as well as more fun session. Okay, so just to test if everything is working well with sound and the chat box and everything, if you could send a quick message just saying hi. Maybe you just type, where you are located, or, just a quick message, maybe, anything you would like me to cover in today, or, I read some messages earlier. Some of you said that you have just started trading options. So anything, please share. So that way I know a bit more about you as well. And we make sure we are all ready to be engaged and then participate of the session. So again, we take a greater advantage of it. Let's begin. Okay, let's begin. We have some time to spend together, but the markets are there waiting for us, isn't it? So let's begin. How are you, my friends? Thank you so much for those messages, Lim, Adriel, Miss Violesius. That's fantastic. Thank you so much, everybody. I'm also checking the app at the same time. I'm looking at the YouTube channel. I'm looking at the app. So I just want to make sure I don't miss any of your questions and comments. Okay, so again, thank you so much for that participation. As you can see, the progress for the session, the agenda will have us dive into key headlines, talk about an options lesson that today, as you know, based on the title of today, is going to be about exercise and assignment. And from there, we'll jump into the markets and do a special market commentary about the markets. In the meantime, you can see on the screen, there is a beautiful QR code for you to scan. This is a 0 commission card for US options trading. You have the link probably on the chat box, on the YouTube description in the channel. But I guess the easiest way to do it is just to take a screenshot right now or take a picture right now with your phone, because the QR code is there waiting for you. So I'm not getting any messages on the app. I'm getting messages from you guys on the YouTube channel, but not on the app. So I'm not sure if I have a little issue on my end, or maybe you guys have not said anything on the chat box yet, or maybe I'm missing it, or something's happening. So yeah, just know I cannot see messages on the app for whatever reason, but maybe you haven't typed yet. So I'd love it if you could just say hi, okay? So that way I could confirm if I have an issue with the app or not. Anyway, so let's begin. My name is Jose Blasco, as I said. Again, I really dislike to go over introductions because this session is about you. It's not about me at all. But anyway, I am a trader. I love the markets. I trade all assets. And in case you haven't been in my sessions before, I love options, okay? In case you didn't know, and this often gets me excited, and therefore sometimes I end up talking a little bit too fast because it's exciting. So if I go too fast, slow me down, type it on the chat box. If I go too slow, let me know so I can spice it up. And if you have any question, guys, no matter if it's very advanced or very basic or anywhere in between, let me be the one, if the answer is coming later or in a future session, let me be the one to tell you, but don't stop yourself from asking questions, either basic or very advanced. Okay, yes, very good. Now I can see now the typing on the app. Thank you so much for that feedback. That helps me a lot. Thanks. Why do I love options? Because options give you options. You had that on the first slide. Options give you options. The more options, the more choices. And certainly it's beautiful to be able to adapt to the market conditions where there is more of a probability in your favor to be directional and go long or short. You can do that with options when there is less of a probability of doing that, and you may want to focus on trading ranges or collect premium. You can do that with options when you want to play interest rates, when you want to play volatility, when you want to play earnings. So there are many things that you could do beyond just buying long or selling short, which is what you could do with all the other assets. And there is nothing wrong with going long and going short. It's actually very, very powerful. But the fact that options give you additional possibilities, given my personality, my background is engineering. So maybe, I just love, if you wish, the healthy challenge of having choices. And, again, I just have this little passion for options. Okay, so hopefully this answers your question. Very, very good question. Our website, in case you are attending this session with me for the first time, you may wanna take a screenshot of this additional QR code. Our website, it's tradewithufos.com. And if you may be wondering what are the UFOs, well, later I will move into live charts and we'll do live market analysis, so you will get to see what that is. But basically, in a very small size, you can see on the upper part of the screen, you have these little flying saucers. They look like flying saucers. They look like UFOs. But in this case, UFO stands for on-field orders. And yes, you guessed it right. If it's red, it's on-field orders to sell. If it's green, it's on-field orders to buy. And in that sense, you can use those UFOs to plan trades more accurately. You can use them by themselves. You can combine it with other trading methods. I'll talk more about that later if that's okay, so we can focus on the lesson now, okay? Headlines. Well, nothing new really. I mean, in case you haven't noticed, when I talk about headlines, I really focus on what matters the most, okay? We could make, we can make like 20 pages of headlines, and many things that are relevant are happening in the world at the same time. But really, when it comes to what may impact the market in a more dramatic manner, if you wish. So I'm pointing at what matters the most, okay? So we have Russia, Ukraine. I guess we all know what's happening. And obviously we understand the impacts, the consequences that apply to US equities, but also many other markets such as commodities, oil, natural gas, etc. Currencies, the dollar, even cryptocurrencies. So lots of impacts given, those headlines. US inflation, and here I need to add something new since we met last time, which is there's been the first raise in interest rates in the US. I'm sure most of you are probably aware of this because it was a big news last week. And again, it's not like it impacted too much the markets because everybody was expecting it. But at the same time, so while it's a headline that to me is way less relevant compared to Russia/Ukraine, the reality is that the following rate hikes that will happen may be very significant, because right now they did what everybody was expecting, to raise 0.25%. That's a normal thing. They have always done that, or almost always done that. So not a surprise, and everybody was expecting it. But what if next time they do 1 full point in one shot? What if the next time they again do 0.25 when everybody's expecting at least 0.50, 0.75? So again, this is something to watch because it denotes and reveals the reality of the economies, in this case, the US economy, which obviously is very relevant worldwide. And it has a direct impact in the markets worldwide, and definitely in the US markets, which is what I'm going to focus the most today, given the fact that we are dealing with options today, right? Today on March 24, we got 50 earnings reports. To be honest, most of them are small companies. Nothing too major, nothing too big. The most relevant would be NIO, which is, as you probably all know, it's a Chinese company that also trades in the US markets, producing electric cars and electric vehicles and things like that. And it was a company that was very much in the news in the past, and it's been dropping very, very badly. And it'll be very interesting to see what the earnings reports are, which are happening today. Okay, very good. A few more questions there. Nighthawk, I will say your YouTube screen is not clear. Perhaps you can sharpen the focus. I am using an embed mechanism in the PowerPoint presentation done by the Zoom meeting rooms, which unfortunately it's not as crystal crisp as a proper studio camera. So unfortunately, I could not improve that at this moment in time. But good news, in a moment I'll just remove myself altogether from the screen, and I'll get the charts real time. And believe me, the charts are more important than me, even though I appreciate that. Okay, and I hope. And then, and by the way, if you're watching this through YouTube as well, maybe what's happening is that your resolution is a bit low. So you can always click on the bottom settings wheel on YouTube and select resolution to be, full HD or 720p or something like that. And this also should help in case that was the reason. Okay. Then it's clear for me, maybe your connection. Okay, got it. Thank you for confirming that, Zen. Thank you for confirming that. Very good. Perfect. Okay, so with all of this said, let's dive into our lesson for today. Again, this is a critical, very, very relevant lesson. When you buy an options book and you read an options book, for example, when they get into, options exercise, options assignment and things like that, is like the books get very serious. Like, exercise or assignment is such a big deal. To me, as an options trader, given the fact that I understand what options exercise and assignment do, then to me, that's not a big deal at all. It's a very simple thing. And sometimes I even, get assigned or use exercise on purpose, and I'm a happy trader, not a problem. But at the same time, the issue is that many traders trading options are not fully aware of the implications around exercise and assignment. And next thing you know, they get exercise or auto exercise, or they get assigned, and then next thing you know, they don't even know what that is, and now there is a huge margin impact on the account. They may even get a margin call, and they don't even know why it happened. And this is one of the dangers, if I could use the word danger, of trading options, which is, to be honest, if you trade options the proper way, it's actually less risky compared to trading the underlying asset class, right? But it also depends on the option strategy that you use. But in any case, the danger in this case, in this context, what I mean is when you are a trader and something happens and you plan for it, then risk is under control. But when you don't plan for something to happen and that happened, for example, you don't know what's assignment, and I'm not saying that's you, I'm just speaking generically. Let's say you don't know what's assignment, and now you get assigned. So then something happened, you have no idea what it is. So then you have zero control over risk. And that is obviously something that we as traders, no matter if you're active or passive, this is something that we should never allow. You should always understand what is it that you have in your hands so you can mitigate and manage your risk. So expose yourself to the market opportunities in a way where your risk is under control, instead of, let's see how lucky we get today, because obviously that is a very, let's call it a gambling mentality versus a serious way on how to look at trading. Okay. And obviously my approach here, it's the professional approach to trading, which to me, even when I trade, let's say for example, I sometimes, help some of my friends to take a trade or two, and maybe those are accounts which are not that large, and you could think like, I do it because I love it. It's a hobby. Well, even if it's a hobby, even if you trade as a hobby, or it's a side activity that you do or whatever, to me, that trading time is serious time, is professional time, is business time, and risk has to be under control, no matter the size of the account, no matter how long or how often and how active you are when you trade. Because if you learn to trade while you manage your risk, then you will find yourself trading many, many years in your life, where if you don't know how to manage the risk, there is a moment in time where the market, which is bigger than us, will basically teach who is who, because again, the market is bigger than us and we have to respect that fact. Is that making sense? So again, very serious lesson for today, while very simple terms as well, concepts to be understood, very simple, but at the same time, many people out there don't understand them, or they're scared or concerned about it, and you'll see how it's simpler than that. Okay, so a few questions. How to watch in YouTube? You can just get on YouTube and type Tiger Brokers Singapore, and you will see the channel. Just click on it, and the video is live at the moment, so you can just connect this way. And also Swig one question, assuming strike price is 100, what impact when you sell a put at 130 under? Okay, so very good question. If you don't mind me to answer that question just a little after the lesson, because the lesson will answer 80% of your question, and then I'll add the remaining 20%, and you will see how all is clear. Okay, nice, love it, love it, love it. So first of all, when we trade options, okay, and we talked about this in a past lesson, when we trade options, you are dealing with rights versus obligations. For every option seller, there is an options buyer. For every options buyer, there is an option seller. In other words, let's say you buy a call today, you buy a call because someone sold it to you. Let's say you sell a call, you sold a call today because someone bought it from you. Let's say you sell a put, you sold a put today because someone bought it from you. Let's say you buy a put today because someone sold it from you, sold it to you. Again, hopefully I'm not driving you crazy with the words. It's just 4 combinations, and that's why I got a table with 4 quadrants. Options are tradable contracts that convey rights to the buyers of the contracts. So if you are a call buyer, you have a right. If you are a put buyer, you have a right. Where the sellers of such contracts, they acquire obligations. So when you sell a call, you have an obligation. When you sell a put, you have an obligation. Okay. Now, a right and an obligation to do what? Okay. Well, if you buy a call, your right is to buy shares at the option strike price before expiration. Of course, after expiration, the option has expired, so you have no right. So on or before the expiration, you have the right to buy shares if you buy a call. Okay, if you own a call, you are the call buyer, you have the right to buy the shares. If you buy the put, you are the buyer of the put, but your right is not to buy shares. Your right is to sell shares at the option strike price on or before the expiration. So again, if you're a buyer of calls or puts, you have a right. Buyers have rights. Sellers have obligations. If you sell a call, you may be assigned. I'm just adding a few additions with terminology. I'm going to clarify this in a moment as well. But if you sell a call, you may get assigned. And if you get assigned, you are obliged to sell shares at the option strike price. If you sell the put, you may get shares put to you. You may get assigned and you get the shares put to you. So you have the obligation to buy the shares at the option strike price. This, by the way, is the reason why calls and puts are called calls and puts. If you have to fulfill your obligation on a put, which is you are obliged to buy stock, another way to think about it is that you get shares put to you. That's why the put is a put. You get shares put to you, or you put shares to someone else. If you are the buyer of the put, you have the right to sell to someone, so you can put the shares in someone's hands. If you sold the put and you have the obligation to buy, you may get the shares put to you, right? On the call side, it's the opposite. If you own a call, you have the right to call away shares from someone else. So you may go long shares, you buy shares because you have the right to call them away from someone else. That's why the call is called a call. If you are short a call, if you sold a call and you get assigned, you are going to have shares called away from you. So you are obliged to sell the shares. You are obliged to sell your shares to someone else, which is the person calling you away. Okay, calling your shares away from you. That's very English. Anyway, so this is often very confusing. Well, if you think about it, it's 4 cases. It cannot be that confusing as long as you spend 10 minutes thinking about it. Then it's clear. Of course, if I say it very quick, like I'm doing now, it may be a bit confusing. Okay, so let me repeat one more time. When you buy options, calls or puts, you have rights. When you sell options, calls or puts, you have obligations. The call rights and the put rights are opposite. Call is buy, put is sell. The call obligation and the put opposition, and the call obligation and the put obligation is opposite. The call is sell, the put is buy. Okay. So again, for the experienced options traders out there, you're probably falling asleep now because you know this by heart. For the new traders, I would expect that while this is clear, at times it may be a bit confusing because it's easy to forget, it's easy to mix it up. So again, you may want to take a picture, you may shoot me an email, I send you the slides, whatever helps you. But these 4 cases, through practice, you take 10 options trades, and now you know that forever, for the rest of your life, because it's only 4 cases, it's very simple. Okay. Now, the keywords I'm using here that I'm adding now is the word exercise and exercise and assignment. Assignments, when something is assigned to you, right? Think about the meaning of that in English language. Let's say you work in an office, you're an employee of a corporation, and they tell you, you have to do that. So you're obliged to do it. If you don't do it, you will have consequences. You may lose your job, whatever. But in exchange for you to acquire such an obligation to be obliged to do your job, you get paid. So this is what happens when you sell options. When you sell options, calls or puts, you get paid. And because you got paid, you have acquired an obligation, and therefore you may get work assigned to you, which you have to fulfill, and you cannot say no. You have to, because you have a legal contractual obligation. Okay, so I'm going to go into examples in a moment, and all of this will be understood. I can see a few more questions in a moment. How to exercise a put, etc. I'm getting there, guys. Bear with me. I'm getting there. Just want to make sure the foundation basis is very clear, because again, this is confusing for many. So when this is clear, then I'll dive into specific examples, and you will see everybody is going to have it clear before the end of the session. Now, when you buy options, you pay. Okay, so like when you pay to rent a hotel room in a hotel, when you pay to buy an insurance policy to protect your car. Every time you pay in life, you have a right. And using the right is your choice. It's not an obligation. You may decide to use the right or not. You may buy and pay for a room in a hotel and you decide, you know what, I'm not going. I mean, that would be a waste of money, but at the same time, it's your choice. You don't have to go to the hotel just because you booked the room. So when you pay, you have rights. You are not obliged to do it. When you get paid, which is when you sell options, you get paid. So then now you have an obligation. Okay. So this is something to be crystal clear. I'll come back to this in a moment. You'll see why I emphasize this so much in a moment. Again, because this is one of the reasons why sometimes traders get themselves into an assign or auto-exercise position and they don't understand why. Okay, so I'll come back to this concept. So let me take a look at the questions there. Hold on, how to do a poor man cover call, how to execute it. Let me try to talk about this at the end of the session. I'm not sure if I will have time, but certainly very good question. I'd love to talk about it. Let's see if I can have time. If not, I'll find time to do it next time, or you can shoot me an email as well. Hold on. Can buyers exercise at any strike price, even though coming back to this, how to exercise a put, coming back to this, when you buy a put physical stock on margin account, does it protect it? Coming back to this Chiliongo as well, I'm going to answer all those questions. Okay, let me complete the lesson because lots of your answers are coming through the lesson. So let me cover that first. So exercising. Question for everybody on the chat box. Question, when you exercise, is it because you bought the option and you have a right? Or is it because you sold the option and you have an obligation? So exercise, is it because you bought or is it because you sold? Please type bought or sold on the chat box. Exercise, is it bought or is it sold the option? So exercising, okay, most active options traders, we buy and sell options as a substitute for stock shares. So in other words, you want to make you want to make a profit out of catching or riding a move on a stock without owning the shares. Why would you want to do that? Well, we talked about it in prior lessons. You got less margin requirements, the trade is cheaper, you have less risk. There is a collection of benefits of buying options. We covered that in a prior lessons. If you missed it, I would suggest you go back and watch it. I won't cover it today, but basically when you want to catch a move and ride a move on the stock and profit from the move without owning the shares, so you avoid such a high cost or such a high deployment of capital, so then you trade options, right? You buy options. You are an options buyer, right? So in that sense, most of those active options traders, we don't have any intention of exercising, because exercising, what it does is to convert, okay, the options contract into stock shares. You convert the options trade into a stock position. That's what happens when you exercise. You exercise, so basically you execute the right you have. And thank you so much for those responses. The responses were 100% correct in the chat box. Congratulations, good job, everybody. Buy is when you have the right to exercise. So you buy a call, you have the right to exercise. If you decide to use your right and exercise the call becomes shares. Question, tricky one, listen carefully. What if I buy a put? If I buy a put, question, do I have the right to exercise or do I have an obligation when I buy a put? Okay, when I buy a put, do I have the right to exercise or do I have an obligation if I buy a put? Please answer that question on the chat box. Buy a put equal exercise, buy a put equal obligation. What's the answer? So exercising can only be done by the buyer of a contract. Exercising is a right, not an obligation, and therefore exercising is not a choice. Is not a choice to be made by the trader. Okay, with American style options, which is the options that we find on the US market in most of the cases, unless you trade options on the S&P index, for example, or very, very rare cases, options on stocks in the US are all American style. And it doesn't mean that trade in the US, because you also have European style options in the US, but it means that you could exercise anytime. With European style options, you will need to wait until the expiration date and then you exercise if you choose to. Well, actually, the process will be automatic. But with American style options, you may still have 10 days to expiration, 10 months to expiration. whatever amount of time to expiration, and you may decide, look, I want to exercise. Lim Yo Bin asked how to exercise a put. You call your broker. You call the broker and you say, hey, I have this put in my account, exercise it. Hey, I have this call in my account, exercise it. Okay, that's how you exercise the put. You can do it anytime without having to wait to expiration. Even though there is something special that happened on expiration, which I need to explain. I'm coming back to this. So buy put equal obligation, Alex, right, then right to sell, exercise. Very good. So as I told you, it was a tricky question. When you buy the put, notice the first word, you buy. So you have the right to exercise. Even though it's a put, it's a right. Let me go back to the prior slide. And that's why I spend so much time here, because it's easy to get confused, even though it's not a big deal, and it happens to all of us at the beginning. Buying a put gives you the right to sell shares of stock. So in other words, if you exercise the put, if you buy the put, you have the right to exercise it. So you can exercise the put and you end up selling shares, as Zen said perfectly. Good job, my friend. Okay, so buying put means right to exercise. It's not an obligation. If you sell the put, it's an obligation. If you sell the call, it's an obligation. But if you buy the put or if you buy the call, no matter which one you buy, if you buy, you have the right of exercising. Exercising, second bullet point, can only be done by the buyer of a contract, no matter if it's a call or a put. If you buy the contract, buy the call, buy the put, you have the right to exercise. Okay? Of course, the outcome is the opposite. Exercise the call, you buy shares. Exercise the put, you sell shares. Okay? Mirror image. Buy, exercise. Question there. Exercise means to sell the call or the put option. Exercise doesn't mean to sell anything. It means to use your right. I'm going to give you examples right now. Jet NG1. What happens when we sell a put and the underlying gets delisted? Coming back to you on that. So, very good. So let me cover obligation, and then I'll come back to a few more concepts, as well as some of the pending questions I have there, which I haven't forgotten. So I told you there is a special case on expiration when you buy an option. Remember, when you buy an option, you have the right to exercise anytime from now until the expiration date, no matter if it's a call or a put. You can call your broker and say, hey, Tiger Brokers, I would like to exercise my 120 call on stock ABC. Do it now, please. You don't have to wait until expiration. You can do it anytime. Why would you do that? Well, maybe the stock reports, the stock pays dividends tomorrow. And if you own a call, you won't get paid dividends. But if you convert the call into shares, of course, you will need much more capital involved, because now you need to deploy more capital, because owning the shares requires more margin compared to owning a call, right? So the capital layout is a big difference. But now, because you own the shares, now you get paid dividends the day after, right? So maybe you call Tiger Brokers and say, hey, please exercise my call so I convert my call into shares. So now I am a stockholder, and now if I get paid dividends, I will collect that, where if I own the call, no dividends for you, okay? So this could be a reason, okay? Again, a bit difficult for me to understand, because with the leverage effect and everything, to be honest, you know, I personally, I'm an option lover, as you know, so I prefer to keep the option, because probably you make more money on that. And by the way, if you get stock and you get paid dividend, typically the stock drops by the amount of the dividend you got paid. So you make the dividend, but yeah, you lose a little bit of performance on the stock because it dropped by the amount of the dividend. So again, to me as an options trader, again, I have a smile on my face. I love options. So I'm not that keen into doing that, but I could understand that an investor maybe is willing to do that. Fair enough. You can call Tiger Brokers and do it anytime before expiration. But what if you got distracted? I'm going to go to an extreme case. Let's say you got distracted, you forgot you own a call, and you hold it all the way to expiration. Okay, which please don't get distracted. Everybody focus on what you have in your account, manage the risk, manage your trades. But let's say you got distracted and now it's expiration day. So what happens? Trader holding options contracts that have intrinsic value that wait until the expiration date, they will be auto-exercised. So what does that mean? Well, intrinsic value is what we covered in the prior lesson. So I'm not going to explain it today because we don't have time. But basically, I'll give you an example. Let's say you own the 100 call and the stock is trading at 101 on expiration. If you own the 100 call and the stock is trading at 101 on expiration, which is $1 higher, that means that you have $1 of intrinsic value. So if you read what it says here, it says that traders holding options contracts that have intrinsic value, in this example, $1, until and wait until the expiration date, they will be auto-exercised. That means that the option expired, yeah, and let's say that's Friday. But then when you look at your account on Monday, you're gonna see there that you have 100 shares of stock for whatever amount of options contracts you got. Why? Because you left an option to be in the money, which is when the options have intrinsic value. We call them in the money. So you left an in the money option expire because you got distracted in this example, and therefore the option got auto-exercised. Okay, you got auto-exercised. So you didn't have to call the broker, but the shares were given to you because the option had intrinsic value on expiration. So again, it's important. Typically, when you buy an option as an active trader and you want to make a profit on a move, so you know where's your entry, you know where's your target, you get into the trade, and when it gets to your target, you're out. This normally will take place way before the expiration date. But again, let's go to the extreme of what I just said. Let's pretend a distracted trader. You left the trade all the way until then, and now what happens? Well, now you got auto-exercise, and now you look at your account and you have 100 shares of stocks per call long or 100 shares of stock per put short, and then you don't understand why. And what's the issue? Well, the issue is that the capital outlay, the amount of use of your capital that you are now using is way more than when you use a call, because now you are actually owning the shares of stock themselves, either long or short, if it was a call or it was a put that had intrinsic value on expiration date. So again, when you buy options, make sure you don't hold them until expiration unless you want delivery of the underlying. Okay? And if you want delivery of the underlying before expiration, right? Well, you call the broker and you can do this example because you want to convert a call or a put into shares, typically a call. Why? Because classical examples, because dividends are paid tomorrow. So that's how you would do it. Now, what price do you get when you exercise? Well, when you exercise, the price you get is a strike price. If you buy the 100 call on a stock, okay, and swig 1N, this is for you. When you buy a 100 call on a stock ABC, you get 100 shares of stock ABC at $100 per share. Why? Because you bought the 100 call being 100 the strike price. If you paid $2 for that call, the $2 are gone. You lost $2 because you bought a call and you held it all the way to the expiration. So the $2 you paid on premium value of the option is called premium. The $2 are gone, but now instead of a call, which is gone, you now own shares of stock at $100. Now let's say the stock is trading at 108. So you own the stock at 100, which puts you in a position where you are making $8, but you also lost $2 if you pay $2 for the call. So you are netting $6 of profit as a stockholder. So you bought the stock at a very good price by only risking $2 when you bought the call, because when you buy a call and you pay $2, the most you can lose is $2. So pretty smart, pretty cool. But again, if you got distracted and you didn't want to own the shares and the stock is trading at 108 and you own the 100 call, guess what? You will be auto-exercised. And I'm making this point multiple times with multiple examples, because traders that are not aware of this, and I want to make sure everybody's aware of this, okay? Traders that are not aware of this, that then get in trouble with maybe a margin call because they don't have enough capital in the account, things like that, and then they don't even know why. So again, while exercise is a right, not an obligation during the life of the contract, so you could exercise or not, when you get to expiration, if there is intrinsic value, and it may be only 1 cent, okay? You own the 100 call and the stock is trading at 100.01, maybe only 1 cent, you will be auto-exercised, okay? Which is the same as you exercise manually, but it's happening automatically, okay? So again, long story, many repetitions, but it's because it's critical, and I don't want you to get in trouble, my friends. I need you to know what you have in your hands to trade safely, okay? You bought call till expiration. What if I don't have sufficient capital? So you will be auto-exercised. You'll get the shares and you'll get a margin call. Tiger Broker will contact you. They will ask you to add more capital to your account, or they will liquidate your position for you because you didn't have enough capital, which may imply an additional loss for you because maybe you get the stock on Friday, and then on Monday, when they liquidate the position for you, the stock opens gapping down. Happens many times that the US market opens gapping down and whatever. So you get stock at Friday price. Sorry, you get stock at your strike price, wherever the stock was on Friday. And if on Friday the stock gaps down, because now you own the stock, so you're gonna get a penalty. Now, of course, you can also be lucky and the stock gaps up, and now you get liquidated and you made an extra profit without having the capital needed to own the stock. So it could also end up going well, but that's just being lucky. Okay, this is not a serious proposal. Okay. Very good. Wonderful. More questions. What happens when we sell a put and the underlying gets delisted? Selling a put, I'm talking about that in a moment. Does the put value drop to zero, or is it you get assigned? I'll talk about that in a moment. In the Tiger Trading Broker, if you see close or sell, which one we need to exercise? None of them. Close or sell means buy to open the position, sell to close the position, or vice versa. Exercise is action number 5. In options trading, you can think of 4 actions: buy to open, sell to open, buy to close, sell to close, and action number 5 is exercise. That is normally done over the phone. It's not an active action. You don't need to have that on the app. You may do it on the phone. You may do it on the chat. Normally you have to contact your broker, okay? But it's not a trader, okay? It's a special action. Think about it this way. Here we go. Yes, and you could certainly exercise early, as I said. Yes, perfect. Great questions, my friends. Okay, now let's talk about assignment, and then I can talk about the puts as well that you had. So most active options traders buy and sell options as a substitute for stock shares, and therefore they have no intention of being assigned. Just like most active options traders, they have no intention of exercise. Most option sellers, they have no intention of being assigned either, unless if you are more in the, let's call it, investing side. And if you're on the investing side, then you're not an active options trader. You are an options trader, but less active. Okay. And that's a very good application, by the way. It's like you want to own Microsoft. Maybe you are doing value investing. Maybe you're looking at fundamentals. Maybe you have whatever methodology, and you're like, I would love to own Microsoft, but I want to own it at a lower price. And I'm willing and ready to be committed to buy Microsoft at that lower price if Microsoft was to ever fall. And for me to absorb and assume this happy commitment, I'm willing to get paid to assume such commitment. So what do? You sell a put. And if you sell a put, now you have the obligation to buy the stock. Again, if I go back, I need to speed up a little bit the lesson here, guys. But if you see the put, if I sell the put, I have the obligation to buy shares. So if I want to acquire the obligation to buy shares of Microsoft at a lower price, I can sell a put on Microsoft, get paid premium. And if Microsoft doesn't fall, I keep the premium because the option expires, even though I didn't put Microsoft. But if Microsoft drops, then Microsoft will be put to me. So now I own Microsoft, which is what I wanted. And on top of that, I keep the premium, which is what I've been paid for me to assume such an obligation. So that's an investment technique. That's not active trading. I mean, some big investors do it a lot. So you could think about it that is active. But from a speed of in and out, I would say this is more of an investment type of strategy than an active, directional type of strategy. So in other words, if you are very active, typically you sell options with the same intention as when you buy options. Okay. So for example, I had a question here before. Let me find it. Where was it? Yes, a Sui Guan Eng question. Assuming strike price of 100, what impact when do we sell a put at 130? Okay, so I'm just a bit confused here. Not sure if the stock is at 100 and you sell the 130 put, or the stock is at 130 and you sell the 100 put. So let me give you the two answers. So let's say the stock is trading at 130 above and you sell the 100 put below, right? So again, you get paid premium. If the stock falls to 100, it's put to you. Now you need to fulfill the obligation and buy the stock, which is classical investment strategy to get stocks at a discounted price, which is very nice. As long as you know how to build a portfolio of stocks, it's very nice. Now, what's a different, but that's not active. Okay, now what if you do the opposite? What if the stock is trading at 100 and you sell the 130 put? So you sell a put in the money. So what's the only way you're going to make money? Well, you're going to make money if the stock goes up. So now you are the rational, right? And that's, to be honest, the risk profile of that would be just like doing a cover call, buy the stock and sell the call. This is just for the options guys in the room. So selling an in-the-money put is the same as doing a cover call, same story. If you want us to talk about this in a future session, shoot me an email. Delighted to talk about this more in depth. But basically, that's what it is. So in other words, the only way you make money is the stock goes higher. Okay, so you are now active. Okay, and you need the stock to go up. And if the stock goes up, then you're going to close the put and you're out. So in other words, if you're active, typically you don't want to go through assignment. If you are less active, just like when you do exercise, we discussed earlier, same thing with assignment. When you are less active, then you may welcome or you may be assigned if wrong. So being assigned can only happen to the seller of a call or a put, not to the buyer. Being assigned is an obligation, and therefore it cannot be stopped. It's not like, hey, you receive an email from Tiger Broker that says, hey, you have been assigned 100 shares of Facebook, should say Meta. And you say, no, I don't want them. I changed my mind. You cannot do that because the moment you sold the put, you got paid premium. So you acquire that contractual obligation in a regulated exchange. It is not a joke. You cannot step away from that. And therefore, depending on what the market does, you will make money or you will lose money or you will get delivery of the stock, which is, if this is what you wanted, congratulations. It's a great thing to be assigned. That's what I said. There is no big deal. There is no need to be over concerned about it as long as you know what's assignment. The problem is when options traders sell options without understanding, they may get assigned, then they get assigned, now they own shares, now they may not have enough capital to own shares, they get a margin call, and now it's a cascade effect of issues, and everything started that they didn't know what assignment was, okay? So assignment means you will need to fulfill your obligation. Bonus question for you, what's your obligation if you sell a call? If you sell a call, are you obliged to buy shares or to sell shares? What's your obligation if you sell a call? If I sell an option, do it lock my capital? Yes. There are margin implications. Every trade we take, no matter the market we trade, there are margin implications. It also depends on the type of account you have, if it's a margin account, if it's a cash account. So again, it's beyond the scope of today's session, but I would suggest that you contact Tiger Broker so they can give you a list of margin requirements. So you know for every type of options trade you do, what happens when you buy a call, what happens when you sell a call, what happens when you do a spread, buy a call, sell a call, what happens when you do a cover call. So you will get to understand better the margin implications and therefore the capital that you need to do the trades. Okay, so this is to be provided by Tiger Brokers. Okay, so contact them. And I'm sure they will do that. What premium I got for sell put, buying time premium or expiration time premium? It depends on where the put is. If the put is in the money, you get intrinsic and extrinsic value, which is the time value you mentioned, or the time premium. If you sell the money, if you sell the option out of the money, which is below price in the case of a put, then it's extrinsic value only, extrinsic or time premium only. So that's what you get, okay? Cool. So now assignment and expiration. Again, because exercise could happen anytime, like let's say I own a call and I choose to exercise because tomorrow the stock pays dividends and I want to own shares tomorrow. So whoever sold me the call is going to be assigned. And that could happen anywhere in the week, anywhere in the month, whatever amount of days before expiration, it could happen anytime. So a trader who sells options could be assigned anytime. But the reality is that it's typically going to happen, if not on expiration, very close to expiration, typically on expiration, and it's going to happen with the same conditions that we talked about for auto exercise, which is when the options are in the money, when the options have intrinsic value. For example, let's say you want to own stock ABC. Stock ABC is currently trading at 110, and you want to own stock ABC at 100. So today, while the stock is trading at 110, you sell the 100 put, which is below. And now the stock falls and falls and falls and falls and falls. And on expiration date, the stock is trading at 99, which is below 100. So what's going to happen to your 100 put? Well, your 100 put will have $1 of intrinsic value. And it doesn't matter if it's $1 or 1 cent, as you can read on the slide. The option is in the money, there is intrinsic value, you will be assigned automatically. Why? Because someone is being auto-exercised, so you are being assigned, or vice versa. Because you're being assigned, the guy on the other side is going to be auto-exercised, okay? So it works like that, okay? So if the buyer of the contract chooses to exercise anytime during the life of the contract, you will be assigned if you are short the option. If we wait until the expiration date and the option has intrinsic value, then it's going to be auto-exercised and therefore assigned. Okay, cool. Very good. So let me complete the questions, okay, before we move into the live time charts and we do our market analysis, which I guess is becoming a norm that I'm running a few minutes late. I just can't talk about this forever. I love it. Anyway, let me focus on your question so we can get into the markets quickly, okay? So if a seller of a put has no intention to be assigned, based on your experience, when would be a good time to lock in the profit? Just, we are talking about trading methodologies, which if I get there, we need 1 hour, okay? So I would like to welcome you to join us on our YouTube channel, or, you know, on our private sessions that we do, that I gave you coupon codes in the prior session for you guys to access our trading room where we do live trades, and you guys have 3 months access there for free. So I would like to suggest that you join me there so we can talk about trading methodology there, because it would be way too lengthy as a conversation now, unfortunately. Even though I'm happy to discuss it another day in the future, I could certainly think about it, okay? But you need to have a method. So it's not like based on experience, this is what happens. I mean, I can tell you about my experience based on my methods. Another trader with different methods will have a totally different experience. So my question to you is, what's your method, right? And if you are newer to trading options, then you need a method, okay? And we can certainly help you develop that, okay? So we can talk about this in a future session. NG Wei Chuan, if you sell a call, you are obliged to sell 100 shares. Very good answer. That was the answer to my prior question. Very, very well said. Good answers, guys. Love it. That means if we sell the put at the 150 and the current price for the stock is 100, our target is to make sure that the current price does not reach 150 and we close the option. Your target would be to go to 150 or above, okay? As long as you are meeting 150 or above, you're good. You're going to make the same profit, no matter if you are above 150 or you are at 150. So typically when you get to 150, you would exit the trade. No need to stay longer, because even if you stay longer and it goes to 200, you're going to make the same profit that if you got out at 150. But below 150, you would make less, right? The higher it goes, the more you make, but the most you will make is when it gets to 150 or above. Okay. So again, we can certainly get into specific trading applications and strategies as well in future sessions. I'll keep that in mind as we are building the curriculum for next month and beyond. Okay, guys? Cool. Anyway, so let me thank you so much, guys, for so much participation here. Very, very good questions. I am now switching. You probably have noticed that you don't see my screen anymore. Not an issue. I am now switching to the live real-time charts. Here we go. So you should be able to see my screen, still the PowerPoint presentation. Before I get into the lifetime charts, I wanted you to take another screenshot to another QR code. This one is for you to get access to our auto climate tool, which is a tool to understand the climate in the market, so you know better when it's time to be a buyer, when it's time to be a seller, and you have statistics. I'm actually going to use it now to analyze the market, so you could use it to analyze your stocks as well. This is a tool that is free on our website, even though there is an activation fee, which you can waive it if you use the code CLAIM8, as you can see on the screen. So make a note of that code, CLAIM8, and then use the QR code or use this link, tradewithyourflow.com/aclimate, and then you will have a tool as the one I'm going to use now with the real-time charts to do the market analysis, okay? So anyway, I'll get the link back later in case I went too fast, okay? So we're going to do our SMARTT analysis. The first thing I want to check is the market climate and the cycle. So let's move into the real-time charts. Let me get my trading platform here. Here we go. So this is the real-time charts. So first thing, what do we see? So we see the daily time frame of the SPY, which is the S&P 500 ETF. And I would like you guys to focus on the climate, okay, which is currently a climate where we have a thick blue dot. Notice 3 dots ago, we have blue dots, but they were thin. So thin blue dots mean that the climate was not confirmed, okay? The price behavior was not confirming any impulsive type of market condition. The environment was dictating or suggesting that anything could happen anytime. There was no clear bet on going long or going short either from a statistical point of view. So now this is a different story now. After a few days, and this, by the way, we kind of anticipated that last week, when you probably remember the red climate was getting overextended, right? We got multiple red dots where statistics suggest a normal thing to happen is 2, but we had more than 2. So we were expecting to go back from red to blue, and it did, okay? And we had a beautiful trading environment since the last week. Hopefully you guys benefited from that nicely, but careful now, because we are now in a confirmed climate with a thick dot. That's nice. But notice how the duration of this climate is now 6, where statistics suggest that a normal thing to happen is 6. So in other words, the climate has already been developed by the normal amount of time you would expect this climate to last. So what is expected next? Well, what's expected next, it's probably a correction going back to red. And I'm not saying the world is ending and it's going to crash all the way to 0. I'm just saying, based on statistics, typically you would soon get a correction for a couple of candles, okay? Maybe a bit more, maybe it could be 4, maybe it could be 5, or maybe it's going to be more severe. That's not what statistics suggest. Statistics would probably suggest that it's going to be a small correction, and from there the market will resume and go back to blue. Okay, so interesting time probably to take profits on certain trades and get ready to reposition yourself at a lower price soon, so you can get back into trades to the long side again the moment the climate confirms that, which is not the case yet. Okay, so again, this is a tool that you can use in your own arsenal within the context of your own methodology. I'm going to go over market data with options too, which is extremely relevant and important. Okay, I'm going to do it right now. And the first tool I'm going to check, it's these 2 lines that we got above and below, okay, which is the implied volatility for the calls versus the implied volatility for the puts. So blue is calls, gray is puts, and implied volatility means let's call it the extra premium built in the options based on the expectation of the move in the future. So guess what? There's been a lot of fear in the market. Okay, there's been a lot of fear in the market since that day, to be honest, where the puts went above the calls, and since then, apart from this little, change of condition for 1 or 2 days, where the world thought that's it was over and everything was back to normal, then immediately we got plenty of fear kicking in the market with way more put trading than call trading. And, not a surprise that the markets went down, but notice what happened since that date. Okay. Not only the market went up, but lots of put buying coinciding with a climate moving from not confirmed to confirmed. And guess what's happening? Well, the market is moving higher. Even the futures, I'm looking at the S&P futures before the market opens in 1 hour. We are looking at the futures are pointing at 0.44% up. Okay, so lots of buying has been coming in, and again we saw this coming, and we certainly benefited from that as a trader. But again, one more time, caution: the climate is reaching its statistical end, and while it could last longer, and often it does, certainly entering too many positions to the long side now may be just a bit too late to the party. And probably a healthier approach would be to start taking profits, take a little bit of time to wait and be patient for that red climate to kick in, which should happen sooner than later. And the moment the market does, let's say goes up, then does a correction for 2 or 3 days, and now the climate gets blue again, let's get back in for the next wave. Okay, but this is something that still needs to happen. Just anticipating, because I'm not going to see you until next Thursday. So next Thursday we can review the story. I like to think about the market like there is a story happening, which to be honest is what it is. And I like to think about it this way. Now, from an on-field order point of view, notice how the market right at the close enter a UFO. So, of course, that's why it started going higher. But at the same time, careful, the market is going to open at 445, which 445 means that when the market opens, it's going to be right in the middle of a sell UFO. Remember, UFO on-field orders to sell. So that's a lot of selling pressure, which is going to very likely, right at the open, we're going to have the market open up here, but right at the open, I would not be surprised to see a lot of profit taking from the futures traders and the market going down. But if the market comes down to this area around 440 something, again, we got UFOs. So I would not be surprised for the climate to last a bit more until maybe the next UFO is going to bring it down. And now we are in this red climate until maybe we get to this 435 mark or something like that. And this is when now we're going to start blue again. Okay. So you see, with the climate, the options data, and the UFOs, you can start getting ready for the fluctuations of the market before they happen. So you are prepared to take your trades or to take profits or to exit trades when it doesn't work according to plan. Because, of course, while those tools are powerful, like all trading methods, of course, they don't work 100% of the time. So that would be amazing. It's not the case. Okay. So now, call and put implied volatility, we talked about it. Now, from a volume map point of view, take a look. So here's the volume map. Okay. And you can see that, there's been a lot of puts traded in the prior session. Remember, gray color means puts. So 2.1 times more puts traded using March 28 expiration, using March 30, 1.3 puts more than calls traded. So again, decent amount of put trading traded. And this has a lot to do with the fact that many people, were taking profits at this price point and they were hedging their trades. But again, all the other market analysis is suggesting, again, probably an up opening and everything else. Okay. Now, if the market goes down, let's take a look at the open interest. Again, we saw on the UFO chart that we got UFOs there around 440 as well as 435. Okay. Well, from an open interest point of view, notice how right there at 440, we have different decent indications of open interest at 440. So you know what, the market may go down, but doesn't go down as far as I said at 435. Maybe it stops at 440 because this open interest is certainly there, and it's obviously very relevant. It's a very strong support area identified using options data instead of identified using bar data on a chart like it would be done normally. From a buy and sell UFO, I mentioned already where the UFOs are and the open interest. From a market volatility projections, well, notice how everything cooled down. If you remember a few weeks ago, the red line was outside the cone. It was somewhere here outside the cone. Sorry for the terrible drawing. Right now, the red line is inside the cone. And if you recall, the blue lines represent the real speed at which the stock is moving, where the red line represents the expected speed at which they expect the stock to be moving. So in other words, options traders expect the stock to move at a pretty slow pace. And that means that options traders are not too fearful. If they were fearful, like they were some time ago, okay, like, sometime here. So notice here, for example, how the red line on this particular day when the market was falling hard, the red line was way beyond the blue lines. And that means that they were very fearful and lots of volatility kicked in. In the end, it went up, but lots of volatility kicked in, where now they're very calm, which probably many of those large market traders are ready to be buyers, which is kind of confirmed by the options data as well as the market climate. So again, this is not financial advice in any way. I'm counting on all of you guys to have your own trading plans and everything else. But definitely, this is my analysis and my interpretation of market data that we got from our platform Top, which processes not only candlestick data, but also options data into the mix to give us that SMARTT analysis, SMARTT with double T, isn't it? For tiger traders, right? And it's indeed revealing market conditions that often you see on the candlesticks after the fact, and we traders can take advantage of that more efficiently. Okay, so again, here's the QR code for you to get your auto climate. I took a full 1 hour, guys, in the session. I'm so appreciative that you guys are with me Love it. Thank you for your commitment to the sessions. Let me quickly check if there is any pending question that I missed. If you have to go, I'm done, apart from the pending questions. So I'm going to review the questions and complete the session. Thank you for joining me, guys. I will see you next Thursday. This is, again, I love the trading aspect, the community aspect. I love Tiger Brokers. I love, I used to be, many years ago, I used to be a university professor. So, you know, lecturing, teaching is something I enjoy very much. Thank you for joining me and giving me the opportunity, guys. And thank you, Tiger Brokers, as well, for hosting me. It's a lot of fun. Let me see the final questions there. So what happens when I use an investment strategy that you share to sell a put? I don't mind getting exercise. You will get a sign. When you sell a put, you get a sign, not exercise. I don't mind getting a sign, but the underlying gets delisted before expiry. So what happens? Well, what happens is that you lost the whole thing, because when you sell a put, there is a put buyer on the other side of your sell, right? So the put buyer has the right to sell the stock that got to zero at the price of the strike. So if you sell the 100 put, someone bought the 100 put. That person who paid you premium to buy the 100 put from you has the right to sell you shares at 100 while the shares are worth zero. So what happens? You lost the whole thing, right? So in options trading, if you are dealing with risky assets such as ADRs or certain stocks, which could be, you know, a very daring bet, if I can say it that way. So instead of selling a cash secure put or a naked put, for instance, then what you could do is you could do a put spread where you sell a put and you buy a put against. So if you lose, even if the stock goes to zero, you have a limited risk no matter what. So you could do that. But when you sell an option by itself, okay, either if you do it naked or you do it cash secured. Cash secured means it's you do it using as a collateral your capital. So what happens? Stock is put to you at 100, the stock was delisted, so it went to zero, so you lost the whole thing, right? So that's a terrible situation. And again, when you sell a put, you are doing it as an investor. So probably you are running a portfolio of many stocks, and the capital allocation you allocated for that ADR was very tiny. So if the stock goes to zero, gets delisted, it's a terrible news, but because it was a very small portion of your portfolio, you can survive that. Now, if you do that with all your money with one stock only, you are totally not diversified, and that's extremely risky because you don't have any investment diversification methodology in place as an investor, and investors should always be diversified. So again, that's why then sometimes, I'm not saying this is you, don't get me wrong, please, I just want to add more because again, risk management is key. I need you safe. So that's why sometimes you will hear comments, you know, in some, maybe you get in reddit.com and you read the story of some guy who lost all their money trading options, and they're like, options are dangerous. Absolutely not. If you use a dangerous asset that got delisted, it doesn't matter if you sold a put on it or you own the shares of the asset. If the asset got delisted, you lost it all. Doesn't matter if it's options or not. You lost it all because the asset got delisted. If you happen to use all your capital in that one asset, you lost all your capital in the account. That's a terrible situation. You should never be there. And that's why you should be diversified. You should run portfolios with multiple stocks, different countries, different sectors. Again, we can talk about this for hours. You should have a proper methodology on how to invest, and then to acquire the stock, selling puts at a lower price is fantastic because you know what you're doing as an investor with a portfolio and you know how options work. Now we are talking, okay? So very good question. Thank you for that, Jet NG. Hopefully this answers your question. Will it be better to do sell than buy since the collecting premium rather than pay premium? It depends. It has pros and cons. If you tell me now where the premiums in the market are low, no, I prefer to buy because you make more money on the move than what you would make on the speed of time passing when you collect premium, when you sell options. But if you tell me a few weeks ago, when everybody thought the world was ending, I was loaded on put selling. Why? Because the premiums were to the roof. So selling premium that was so high would even give me a buffer that allows me to be wrong by a huge amount, where even if I'm wrong in the end, when the amount of money I lose is not so much. Why? Because options are so overpriced that I love to sell them. So there is no methodology which is the best all the time. It's all about timing it, okay? You need to understand 2, 3, 4 methodologies. You don't need to understand 200 methodologies, but at least 2, 3, 4. And depending on the market conditions, that's why I'm looking at all the data I showed you on SMARTT. Depending on the market conditions, then you go for debit spreads or credit spreads or naked options or credits or debits or non-directional or directional, and options give you options, okay? I believe someone, Miss Violesius, was asking me at the beginning of the session, okay, options give you options. Now you understand, isn't it? So that's the beauty, and you can be very safely positioned, okay? But you need to understand what you have in your hands, okay? To do it very efficiently and safely. Collecting premium has advantages, better in certain circumstances. You need capital. You also need capital to buy options, isn't it? So again, pros and cons. Well, delisted typically is the same as going to zero in most cases. There may be special cases, and again, when you talk about ADRs, also it may involve regulation from other countries. So then I would say, what if? Okay, there is what if scenarios depending on the regulation of each country. Maybe it's a stock in Brazil. I know I don't trade stocks in Brazil. I don't know the regulation there. So again, there may be scenarios where a stock gets delisted at a specific price, and then your put obligation and your P&L is in line with that last trading price before the stock got delisted, which basically implies that you cannot get put shares to you, or you cannot be called away shares because they don't exist. So then what you have is a cash settlement in your account. To make it simple, let's say the stock was delisted at 100 and you own the 120 put short. So the stock will be put to you at 120, but it cannot be put to you because it doesn't exist. The last trading price was 100. So the math is, let's pretend the stock is trading at 100 and is put to you at 120. So you just collect a $20 loss, which is the difference between the last trading price and your option strike. Okay, so that would be a cash settlement in your account. You would have a minus 20 times 100 shares, which is minus $2,000 of loss in your account if that was the scenario. Hopefully this answers better. Very good, everybody. One last question I almost missed here. If I sold a put but close it before expiration, do I have to return the premium received? Well, to close a put, you have to buy it back. So it's not about returning the premium. The premium is yours if you wish when you sell it, even though it's going to be kept as a collateral by the broker. It's kept on the side, but it's okay to think it's yours, right? But to close a put you sold, you have to buy it back. So there is no action which is closed. The action is buy or sell. Okay, now buy or sell could be buy to open, sell to open, buy to close, sell to close. So in this case, you would do buy to close. And therefore, for you to buy to close, you have to pay. So the question is, how much is the option worth it at that time? If you buy to close and the cost of buying is less than what you sold it for, so then you make a profit. If the close to buy to close is more than what you sold it for, so then you take a loss. Okay, so it's not about returning the premium, it's that you have to buy to close, and buy means you pay. Sell means you receive, buy means you pay. So it's all about what's the real-time price when you close. Okay? Very nice, my friends. I'm having a lot of fun. I love it. I can see passion for options is building up. Very, very good questions. Congratulations, everybody. We really need to go, guys. Take care, everybody. See you next time. See you next Thursday. Bye-bye.